Hi, everyone. Something came up this morning. I found something out that was very important, and I wanted to tell you all about it. But I need you to please excuse the sort of dark tone of this video because I'm angry, and it's going to be a bit of a rant. But please stick with it because I really think that this is important. These clueless Keynesians are out to kill us all. As Richard Doty, he's also known as the Mogambo Guru, is famous for saying, "We're all freaking doomed." Now, I found out about this morning when I was listening to my 2-minute news briefing. If you've ever been to the homepage of goldsilver.com, every day there's somewhere between 50 and 150 stories that are put up there. I've got a guy that scours the internet all day long and posts stories that affect me and my investments and my business. They're the things that I want to know about because I can then make decisions on the future and I can make plans. A lot of this stuff it's not contained in the mainstream media. But I don't have 4 hours to go through all of this stuff. So I have another guy that combs through all of this and then creates a news briefing every morning from me that's somewhere between 2 to 4 minutes. And it usually touches on 3 or 4 stories. And this one was just unbelievable this morning. For those of you that don't know, Ben Bernanke, the former Fed chairman, has started blogging. That started a few months ago. And on April 1st, he wrote that there is still a global savings glut. This guy does not understand fundamental economics. It is just absolutely amazing that people like this can be running the economy. For 15 years now, he's been saying that we've got this global savings glut. He used to say that, these poor farmers in China, that there was nothing that they could do with their savings except loan it to Americans so that we could go out and buy more SUVs and our presidents could throw a few more wars. So, yeah, I'm furious about this. He doesn't understand that the reason that China was buying bonds from us was simply to do what is called sterilizing or neutralizing excess currency inflows. China had a goal of employing a lot of people. They needed to keep their exchange rates artificially suppressed, artificially low, so that they could run a trade surplus with the United States, meaning they're selling us more stuff than we're buying from them, than we're selling them. And that means that excess currency flows from the United States into China above trade equilibrium. And if the People's Bank of, if the Chinese just put that currency on the foreign currency exchange, and see, they can't use the dollars in China. So a business gets all these dollars in, and if they put them on the foreign currency exchange, or the business's bank did when those dollars flow into the businessman's checking account, then the yuan would rise, the dollar would drop, and trade would go back into equilibrium because Chinese goods would get more expensive here in the United States. And everything would be peachy, except that isn't what they wanted. They wanted full employment. So what they have to do is they have to neutralize some of those excess dollars, the ones that are above trade equilibrium. And they do that by the People's Bank of China taking those excess dollars and buying U.S. Treasury bonds and then holding those as foreign currency reserves. This is the reason that China has the highest foreign currency reserves in the world. Now, the fact that they took dollars that were going into a businessman's checking account and bought bonds with them means that the businessman no longer has that currency. So what the People's Bank of China has to do to be able to accomplish this is to replace those dollars with yuan at whatever the current exchange rate is. So when it was like, I don't know what it is today, but it was around 6 to $1 recently. And so for every dollar that comes in that they take and buy a treasury bond, they have to print 6 brand new yuan and give to the bank that has that businessman's account. So all they were doing was sterilizing excess currency inflows. It was the government doing this. It had nothing to do with a global savings glut. It had nothing to do with the Chinese population, the average person, the farmers and so on, taking their excess savings in the 90s and in the early 2000s, especially when China was still a much poorer country than it is today. They weren't taking their savings and loaning them to Americans. So anyway, Ben Bernanke wrote this because one of the things that he was saying is that the U.S. personal savings rate is too high, and that is keeping this supposed recovery that we're having, that is all a manufactured delusion. It's a Keynesian, it's an illusion, and it's a Keynesian delusion. And the reason that it's an illusion and delusional is it's all manufactured from a wealth transfer of them creating an extra $3.2 trillion worth of base currency. They've gone from 0.8 to 3.2. They've added 400% to base money, and that stays in the financial system mostly, but what it has done is caused a wealth transfer from Main Street to Wall Street. That's the reason that the stock market is up and everything, is all of this stimulus that they did caused a wealth transfer. It is a theft. It is a fraud, and they should be going to jail for it, but they're not. They're the heroes of the moment. But him saying that we have a savings glut in the United States, that people are saving too much. Well, when you save, if you put that in the bank is supposed to then loan it, and this helps create capital investment. It helps create further consumption. So he's saying that the economy is being slowed down because people are saving too much. Now, what drove me crazy was in the 2-minute news briefing that I heard this morning, there was an analysis of this, and I heard the way that government calculates the savings rate. And it's absolutely insane. I did some further research on it, and I got a congressional report on it. And in the report, it said, savings, in a nutshell, is after-tax income minus consumption. So there it is. It's what's left after a person earns something, pays taxes, and then minus their consumption. So whatever's left over after they've consumed is savings. So I'll go a little further here. Now, this is a little bit mind-numbing, but stick with me because there's a point to it afterwards. This is reading some of the way that they calculate this. The source for U.S. savings data is the National Income and Product Accounts, which is called the NIPA, published by the Department of Commerce Bureau of Economic Analysis, the BEA. The NIPA constitutes the accounting framework which is used to produce estimates of gross domestic product, GDP. GDP is the total value of goods and services produced, and it can be calculated in two different ways. One way is to add up the value of all the goods and services produced, the product side of the accounts. The other way is to add up all of the income earned in the production of those goods and services, the income side of the accounts. So they're measuring savings based on how much stuff is produced in America and what it cost to buy versus how much income was earned off of it after taxes. And they have a formula. And the formula is C plus I plus G plus X equals C plus T plus S plus M. And I'm not going to go into what all of those represent, but there's one big missing component, and this is enormous. And it just shows you how clueless these Keynesians are. They think that there are only two ways that you can spend your currency, just two. You can either pay for current consumption. You go to a restaurant, you order dinner, and you pay for it at the end of the meal. And so you're paying for consumption that you're doing at the moment, today. Or you can pay for future consumption. You save today so that you can pay for something in retirement, or you want to take a vacation next summer, you start saving right now so that you can spend in the future. So you can they think that you can pay for current consumption or future consumption. But what they have not included in this formula, what they completely skipped over, is paying for past consumption. I'm talking about all of your debt service. I'm talking about mortgage payments, car payments, student loans, and credit cards. Yes, even your credit card, you're paying for last month's dinner. And so you're paying for past consumption. They are including paying debt service, past consumption, in savings, because it isn't calculated in this formula anywhere. There is no C plus T plus S plus D. The D for debt is missing from this formula. It's utter insanity. And Ben Bernanke, chairman of the Federal Reserve, who's the same basically as Alan Greenspan or Janet Yellen, it doesn't matter. They are all cut from the same cloth. They are deluded Keynesians steering us off the edge of a cliff. And so I'm sort of done with my rant here. It's just that, I feel, I can feel the day of reckoning getting closer and closer and closer. And it's creating a very uneasy feeling. I think that, later on this year, I think you're going to see the markets top out. I think you're going to see the beginning of what I've been warning about for a long time. Anybody that's a subscriber to my Wealth Cycles reports or an insider knows that, or watches Hidden Secrets of Money, knows that I have been continuing, or anybody that gets the 2-minute news briefing. We have been monitoring what we call the golden nails in the death of the global dollar standard. I've been giving these presentations since before 2010, and one of the things that I see is that when this first started, when we went off of the Bretton Woods system in '71, there was a big calm, and the world monetary system, this global dollar standard, worked just fine until Saddam Hussein wanted to sell oil for euros. That was the first nail in the coffin. And then there was another nail that came a year later or so, or a year and a half. And then they started speeding up. They would come every several months. And then there would be one every month. And then one every week. Well, now there's like 2, 3, 4, 5 of them in a week, where you can see that the end of the dollar's dominance of the global monetary system, that is coming to an end. And with that comes a change in the global monetary system. When I was writing my book, I took every crisis, every stock market crash, every set of bank runs, everything that I could find that was some sort of panic or crisis, put it in a spreadsheet, looking for some cycles, trying to see something that had regularity to it. And what leapt out at me was that every 30 to 40 years, the world had an entirely new monetary system. And I tried to do further research on it, and you could read about the classical gold standard, or the gold exchange standard between the wars, or the Bretton Woods system, or the global dollar standard. But nobody had written to that point about how these all connect together and the changes that happen and the causes for the changes. There's been lots of people that have written since, but to that point, nobody had. When I realized that every 30 to 40 years the world had a new monetary system, I could automatically see that the reason is because that these are all man-made systems. These Keynesians and these economists will never just let the free market work. And because they won't let it work, they have to design something. And there is no possibility, there's no chance in hell that what they are designing can account for all the forces in the free market. And they try to do things like manipulate interest rates and decide how much currency there should be in the system, thinking that they are smarter than the sum total of the knowledge of every transaction in a society. That's the free market. And so they have the arrogance and audacity to think they know more than that. And what happens is their bad decisions cause pressures and imbalances to build up until stress cracks start to appear, and then the whole thing starts to implode, and then they have some emergency meeting like the Genoa Conference of 1922, the Bretton Woods Conference of 1944, the Smithsonian Agreement of 1971, and they try to cobble together a new world monetary system. Well, mark my words, that day is coming where history repeats, and there is going to be an emergency meeting of the G20 finance ministers, so there'll be the heads of all the treasuries, the central banks, and a whole bunch of economists trying to figure out a new world monetary system. And like I have been saying, it is before the end of this decade. And this is what will cause the greatest wealth transfer in history. The wealth transfer started actually back in 2001 when gold came off of its floor of $250 an ounce. And for the people that have given up on gold, they may have bought gold a little higher than the current price, and they sell out, and they're going to be buying back in once it's zooming way past 2,000. But I feel sorry for them. Gold has been, if you look from the year 2000 to today, gold has been one of the best performing assets. It's up about 400%. The NASDAQ is back to break even. That's not inflation adjusted. That's just the points. It's back to break even. The S&P is up about 30%, and the Dow is up 55%. Gold is up 400% during that time period. So my point is, I know this has been a rant. I've been going all over the place, but it's really time for people to find out as much as they can about what is going on and take action with the steps that each individual thinks is appropriate for them. Thanks very much for listening, and we'll see you next week.